Good morning, friends. Today we'll continue with the yesterday's session. That is the preparation for NISM Series 8 Equity Derivatives certification. This certification is very useful for students who want to prepare for jobs in financial markets. Is for either BCom, MCom, MBA, and anybody who are interested in the financial markets. So nowadays you can see huge surge of interest among youth towards financial markets, Indian stock market, how it is functioning. There's a lot of many factors are contributing to this, particularly from the work from home concept and the corona crisis, where many people are stuck up at home. So many have shown interest towards the stock market, how it fluctuates, what are the factors and all. Now let me see to continue this our class from yesterday. If you see, now let us see what are the types of derivatives available in the Indian stock market or in general. So we can classify these major types of derivatives as forwards, futures, options, and swaps. So these forwards and futures is a minor difference. Let us understand what are these contracts. This forward contract, so as we have discussed yesterday, these are all contracts, they are not assets. So this contract has a certain expiry date. These contracts are because it's not like an asset where you can take it and keep it in your house. Now this forward contract, it is a contractual agreement between two parties to buy or sell an underlying asset at a certain future date. So it's basically it is an agreement. A contract is an agreement between two parties to buy or sell an underlying asset at a future date. So we'll take some example like the typical example or standard textbook example. What we give is like a wheat farmer and a company, say like ITC, which converts into an atta, converts into that Ashirwad atta, suppose. Now this farmer is not sure of what price it will be after 6 months. So, and ITC is also not sure what price it will be after 6 months. So farmer expects his crop to come up after 6 months. So what is the risk to the farmer? So suppose presently wheat price is 100 rupees per kg. So when the farmer will be subject to risk, when the farmer can incur losses when it goes down. When the company is at risk, when the company will be at risk when it goes up. Because it has its own estimations, its own costing, all these are built up on the basis of some input estimation. So this, as you know, the input cost fluctuation is a major factor in this. All our now manufacturing companies, it's a big risk. So if suddenly the input cost goes up and the ITC's problems will be, that means its profitability will get affected, and in turn a lot of things. When profitability gets affected, share price gets affected. When the share price gets affected, its capacity to raise funds gets affected, its image gets affected. So it is all sort of a cycle. So that's why you see, the opinion on the company changes with respect to share price. So that is where the feedback mechanism is available. So if you see the corporate finance, in the corporate finance, we say, it is like company performance affects the share price. But the actual truth is, truth, or what we call, I can say truth, the actual what happens in the market is the share price affects the corporate performance. It is a reflexive mechanism, as you might have known. One very big financial person, or you can call speculator or trader, George Soros, writes about this in Alchemy of Finance. Because it is a two-way mechanism, it is not a one-way mechanism. People who participate in the financial markets in turn affect the prices, and they are affected by the prices. I think you have to carefully understand this. In a corporate finance context, the share price will drive the other linked factors. When the share price goes up, people are excited about the company, people are excited about the fundamentals. They will give low cost of capital. That means the company can access funds at a very low rate, and in turn it will generate high return on capital employed, return on assets, and that type of positive feedback or reflexive feedback will be available to the company. Now presently also you can see there's a lot of debate on Twitter about ITC. And one thing I can say about the students interested in finance is, you follow this Twitter. There are a lot of wisdom in Twitter, and a lot of commentary, a lot of education is available in Twitter. So nowadays what happens is, because of this, a lot of, if you can spare some time, Twitter, YouTube, and all these platforms is giving you a lot of information. Only thing is that we should be careful to search for some quality information, and what institutions or coaching institutes does is, they will put information in a particular format, which is consumable by the students. Otherwise, all information is available in the public domain, in the web information is there. So what we are discussing is the forward contract. So forward contract, it is an agreement between two parties to buy or sell underlying asset at a certain future date for a particular price that is pre-decided on the date of contract. So like, the farmer and ITC enter into a contract that they say that 100 rupees per kg, I will purchase after 6 months. So what it will do two things for the both for farmer and the company ITC. So it will lock in the prices, so that there is a risk management. So farmer is sure of the price, IT is sure of the price, so they can go and work out their own costs and all these things. So now what is happening? This contract is between two parties, like real estate transaction. Okay. So between the farmer and ITC. So that's why it is called a over-the-counter contract, OTC contract. There is no intermediary. It is only, and they can negotiate. That means they can customize. It's like, you take a piece of cloth to the tailor and you can say that this should be my conditions, how it should be there. This collar should be like this. No, all these things you can customize according to your needs. Tailoring. So OTC contract is a tailored contract. So forward contract is an OTC contract. So you have to excuse me if I am going somewhere no, here and there in between explaining these concepts. But again, I will come back to the basic concept. Next type of contract is your futures contract. Futures contract is exactly like a forward contract, but only difference is the deal is made through an organized exchange. So now we are introducing an intermediary, that is intermediary or third party, that is called exchange. Suppose there is a that in the above example, if the farmer goes to the exchange, then MCX, multi-commodity exchange is there. If a farmer goes through the exchange and the ITC also goes through the exchange, so there is an intermediary, third party in between the two parties, that is called MCX, and that is called an exchange traded contract. In the exchange traded contract, there is a standardization, or you will fix the terms of the contract. So whereas there it is you can negotiate, but here you have to purchase the ready-made shirt only. So the OTC contract is a tailored contract, whereas exchange traded contract is a like ready-made shirt. You go to the ready-made shop and you buy some Park Avenue shirt. You can't say that now you customize this, you do this, you do that, because it is already predefined terms are there, and that size of the contract is fixed, and the terms are fixed, delivery is fixed, quality is fixed, all these things are there. Now in this you can see that in terms of equity market, we have NSE as the predominant F1 futures exchange. If you see, NSE is in the number of contracts traded, we are the world's number one. So it is a globally also we are in the top. Now, so you know that we have basically top exchanges, very popular exchanges. We have BSE, NSE, MCX, NCDX. Now these exchanges are very interesting business propositions. The exchanges, the depository participants, the stockbroking companies, they're very good investments. If you want to invest for a long term, these are now we are expecting NSE to come in a IPO in the next three to 4 months. Well, a lot of opportunities in this space, like your BSE is listed, MCX is listed, Central Depository, CDSL is listed. It's all you can see an ecosystem of market infrastructure institutions, because we are daily doing a huge turnover of around an average of 20 lakh crores in the market. So that is how, and we have only around 3 to 4% of the people's savings go into financial markets. So our and still, whereas 60 to 70% go into advanced markets, so we have a lot of scope for financialization of savings. So if once this financialization of savings goes, you get a lot of activity in this financial markets. Now, next comes another type of instrument, derivatives, we can say is options. An option is a contract that gives a right but not an obligation. So you can say option buyer. So the options are nothing, like options are what? No, simply we can understand it's like an insurance contract. That means suppose you buy insurance for your two-wheeler, Hero Honda bike. Now I pay 1,000 rupees and insure my bike for 2 lakh rupees or 1 lakh rupees. Now, if anything happens to the bike, that insurance company has to pay. If nothing happens, I will not claim. So that means I have a right to go and claim against the insurance company if there is any problem. So as an option buyer, I have a right. And what happens to the insurance company? Option seller, because he is selling the contract, so he has an obligation. So for every option contract, there is a buyer and seller. Buyer has the right, seller has the obligation. Because buyer has a right, buyer is paying some amount. That is called option premium. So buyer has what? He has a limited risk of up to 1,000 rupees. And unlimited, he can expect compensation up to 1 lakh. Whereas insurance company has limited income, limited profit. That is only premium 1,000 rupees, but unlimited obligation, whatever extent the damage happens. But why insurance company is doing this? Because it has its own calculations that over a large amount of insurance contracts, it can make profit. And what is the probability of getting into a claim, getting this owner an accident? So it will calculate its probabilities. Okay, so that is what we call an option contract. Now, options are hugely traded in national stock exchange. Nowadays, there is a huge boom in an options activity because of a lot of things. We have the transaction costs are reduced by the exchanges, and particularly there is a revolution happening in the discount broking. Earlier, each you have to pay for different brokerages. That means if I buy one for a worth of 1 lakh, I have to pay some brokerage. If I buy 10 lakhs, I have to pay some. Now they said any order, it will get same brokerage, because the broker is not incurring additional cost by worth of the money. It is only the infrastructure is same works whether you buy for 1 lakh or 1 crore in one order. So these are discount brokerages, and youth are entering into the market, and also there is a lot of training and educational resources are available, and option selling has become popular because they say that an option sellers are right 70% of the time. So because this option, there is a specific, we will discuss in the next time, there is option has a specific feature that it has a time decay. The option value loses when it nears expiry, because all these contracts have a fixed time period, and the option premium goes down to zero when it expires. So when it will goes down to zero, and all there is a will come into the next classes. And another type of contract is a swaps contract. This swaps, now this swaps is an agreement between two parties. So it is a OTC contract. We exchange cash flows in the future according to pre-arranged formula. Swaps are series of forward contracts. So swaps, basically it is like managing your currency risk. So it is like swapping. That means I have something and you have something. We will exchange because I want what that means. Suppose you are having one extra pen, and I am having one no pencil. So I want pencil, you want pen. So we will exchange between. So this is how the various types of contracts are available in the market, and there is a huge interest in the derivatives market. Now 90% of the trading is done in the derivatives market in India, if you see. So this is one of the advantages of derivatives market is we are separating speculation from investment. So investment is clearly done in the cash market, and if you want to trade or speculate or risk manage your risk, you go into the derivatives market. So where is the this F&O segment and cash segment? So where are they? They are in the same no terminal available to you, but it is demarcated as the segments only. So all the markets are available in the screen to the investor. That means very flexible to invest or trade. So that is one of the important development nowadays is to make the job of the market participant easier to participate in the market. Okay. Thank you very much. We will continue in the next class and continue to discuss. If you have any questions, please type in the comments box where I will be able to take it up. Thank you very much.